Kerajaan hari ini memutuskan untuk melanjutkan pelaksanaan Perintah Kawalan Pergerakan untuk tempoh 2 minggu lagi.
2 minggu lagi.
Arg! Arg! Hey everyone, first of all, we'd like to say that we hope everyone's doing okay during this movement control order.
I can't do it. I can't do it.
Personally, my hair is getting longer and my beard is my only way to know what day it is. In this video, we're going to be talking about 3 stocks that we've recently purchased. My name is Emir and welcome to the Millennial Finance. Over the past month, global stock markets have crashed, entering the dreaded bear market, which means stocks have declined 20% from their previous highs just last month. We're not immune to this. As of the 24th of March, our own stashaway accounts are down by up to 30%. Thankfully, we haven't yet started building our stock portfolios. As mentioned before, we think this is a perfect time and we're super excited to start building our portfolio. Stocks are at a bargain right now. Fresh from new highs just a month ago, they've fallen to levels that we saw back in 2017. Is this the bottom though? Honestly, we don't know. And like we said, if anyone tells you they know, don't listen to them. So what do we do when we don't know when the bottom is? Well, we've decided to take the approach where we're going to enter the market slowly in batches. This way, sometimes we may get stocks at higher prices while others will get it lower. On average, we should be getting good prices for our stocks. Anyway, a few dollars difference in prices doesn't really have a big impact to long-term investors like us. Before we reveal the 3 stocks that we bought, we just want to mention that just because we bought these stocks doesn't mean you should. We always want to encourage all our readers and viewers to do your own research and just use this as a point of reference to purchase your stocks. Without further ado, let's get started. The first stock that we bought is Facebook. We bought this at a price of $149. Facebook is one of 2 companies that is nearly monopolizing the entire digital marketing industry. The other one, Google. From 2015 to 2019, Facebook has grown their revenue by a tremendous 271%. Since the start of the pandemic, Facebook's share price has dropped from a high of $220 per share to its current price of $148. Now, this stock will probably be impacted by the coronavirus. In the short term, we expect smaller and medium-sized businesses to spend less on advertising. Currently, 99% of the revenue is being generated from advertising spend. However, with lockdowns all over the world, we feel that increased audience and a shift towards e-commerce will help with Facebook's ad revenues. For example, as people start to get bored at home, they'll start going on apps like Facebook, Instagram, Twitter, and Snapchat, which means more eyeballs for Facebook. Generally, the bigger the audience they have, the more revenue they can generate. Once everything goes back to normal, we expect Facebook's revenue to recover quickly as merchants fight to regain market share that they once held. To add icing on the cake, Facebook has an extremely strong balance sheet. What this means is they have enough cash on hand to pay off all their debts. Even if their revenue goes to 0, which is highly unlikely, there is literally 0 chance of them going bankrupt.
0 chance.
Now, I'm gonna be honest with you. When I'm looking to chill and just scroll through my phone, Facebook isn't the first app that comes to my mind. Within my circle of friends in Malaysia at least, Facebook seems to have lost their spark a bit. However, we have a lot of friends from other countries who still use Facebook as their #1 social media platform. Aside from the Facebook app, most of you probably know that they also own Instagram. In 2012, Facebook acquired Instagram for just $1 billion US. Now Instagram is something more along our alley. Other than Instagram, Facebook also bought over WhatsApp in 2014 for $18 billion. While they haven't quite yet figured out how they want to monetize WhatsApp, Instagram has slowly started to pick up steam with advertisers. They're currently looking at launching ad monetization for their popular video streaming service IGTV. Also, there are plans to roll out Instagram checkouts globally. What this means is merchants no longer have to redirect customers to their website where they can then do the entire checkout process right on Instagram. This then helped Facebook with their economic moat. Starting off with just Facebook, they then acquired Instagram for people to start uploading pictures, and then WhatsApp, which is a communication tool. Once they have Instagram checkout, merchants can start to look selling directly on Instagram, which positions Facebook as not just a social media company, but also an e-commerce one. We're not going to ignore the fact that Facebook has their regulatory issues, such as their role in Cambridge Analytica. However, we have faith in their management, and recently an article mentioned that they probably have one of the best management teams in the US. We think that they'll overcome this. They'll start to realize the importance of privacy to consumers like ourselves and the resultant impacts on their revenues. For these reasons, Facebook gets the honor of being the first company in our portfolio. The next stock that we bought is Uber at $21.50 a share. Okay, I'm gonna admit that Uber is a bit of a risky one. I worked at Uber Malaysia as an intern about 5 years ago. Being the first mover in now a wildly popular ride-hailing industry, they are starting to see that their position is being challenged by local players such as Grab, Lyft, and Yandex. Despite this, they still managed to triple their revenues in 3 years to $15 billion in 2019. One thing that is very important to note about Uber is they're not a profitable business. However, a good sign is their management recently released a report that said that they are expecting to go profitable by the end of 2020. We don't know the impacts of the coronavirus on this timeline, but still, the fact that they have a path to profitability is really something that interests us. In the second half of 2019, Uber's financial reports really started to look upwards. Their shares, recovering from a low of $20, went all the way back up to $40, doubling in value. However, the pandemic took all of this away, bringing Uber's share price back down all the way to $20, which is where we entered our positions. In the short term, we definitely expect an impact to Uber's ride-hailing revenues. Currently, airport rides contribute to 15% of Uber's revenues, and we know that no one's going to the airports, are they? Still, we see two potential upsides to Uber's revenue during this downtime. The first one is some people still have to go to work despite the pandemic. When people commute to work, they would probably rather take an Uber over taking public transport. You don't want to squeeze in a tight space with a million other people when there's a virus that spreads so easily. Just last week, Uber's main competitors in the US, Lyft, reported that they recorded their highest revenue in a single week ever. While Uber didn't personally say this, we expect that when Lyft benefits, Uber should also see the same benefits. Secondly, Uber also has a food delivery business called Uber Eats. How it works is very similar to GrabFood. Because we're not able to go out, we still need food and we can't be cooking every day. When everyone's locked up at home, demand for food delivery services should spike. In the US, a food delivery company called Blue Apron has seen its valuation go up by 6 times just since the pandemic. Currently, Uber Eats only generates 17% of Uber's total revenue. However, we're gonna keep an eye out on how much this number increases, and we expect it to be significant. While Uber will definitely take a hit in the short term, we see these two measures will help them slightly offset this number and hopefully still maintain a growth in revenue. For the long term, Uber definitely has more room to grow in the ride-hailing industry. Having presence in over 70 countries, there's definitely still more potential, especially in the continued rise of mobile penetration and an increasing in number of middle-class citizens. We're not going to talk about their ride-hailing services though. What we want to look at in the long run is a more exciting and more risky business which Uber is starting to look at: automated drivers. Over the past few years, Uber has poured a lot of money in this business. Their self-driving business alone is valued at $7 billion, which is 20% of Uber's entire valuation. And they haven't even got anything out yet. To give you context, how Uber makes money is whenever people make a booking for a ride, they will take 20% from their riders and keep it as their own revenue. The difference in how much customers pay Uber and how much Uber actually gets is $50 billion in 2019. With the introduction of driverless cars, they would no longer have to rely on their drivers and instead get the entire pie of the customers' wallets. This is a big potential for Uber. Management consulting firm McKinsey expects driverless cars to be on the road within 3 years. So Uber is in the race to become one of the first companies to bring driverless cars to the market. However, we feel that even if they don't win this race, they will still benefit overall. Even if a company like Tesla manages to bring out this feature first, Uber can then just rent out their cars and brand it as Uber vehicles. The only thing for Uber now is to make sure that they can get this up and running and get the proper regulatory approvals before they run out of cash. I want to say that Uber is probably a risky investment. However, their valuation now at just $40 billion was too cheap for us to pass up on. This is a high risk, high reward play for us. We believe that if things go to plan, Uber could potentially be our next 10-bagger, which means an investment that goes up by more than 10 times of our investment. A big reason that we invested in Uber despite these difficult times is they just recently announced that they have $10 billion worth of unrestricted cash flow. This means that even in the worst case scenario for Uber, they will finish the year with $4 to $5 billion worth of cash, which means they won't go bankrupt. Since we think the risks are manageable, we are putting in just a small amount of money which could potentially grow by up to 10 times. So we think the risk-reward ratio for Uber suits perfectly for us. Okay, so we've got Facebook, we've got Uber, the next one is Visa. Who put this in my stock portfolio? Despite Visa being a well-known brand, a lot of us probably don't know what they do. They don't give out loans, they don't store our money. What do they even do for us? According to Google, along with MasterCard and American Express, Visa is actually a payment processing company. What this means is they connect customers like myself, banks, and merchants to enable the transaction and settlement of purchases. Boring. Over the last 3 years though, Visa has managed to grow their revenues by over 15%. Due to the nature of their business, their net profit margins are an incredible 50%, which means that for every 1 ringgit that they make in revenue, they make 50 cents in pure profit. Now this is a business that I like. Just a month ago, Visa was trading at its all-time highs of $214. When I purchased it, it was only $136. First, we need to understand how does Visa make money. What they do is, they take a small fee from every purchase made using their brand. For example, I have a Visa credit card. Whenever I spend 100 ringgit at KFC, Visa probably collects 2% from my bank, which is Maybank. We all know that the pandemic probably reduces the amount that people spend. When people spend less, Visa makes less money. A glimmer of hope is that since the pandemic started, people have started to spend more on e-commerce such as Lazada, Shopee, and Amazon. And when we buy online, we tend to use our credit or debit cards because we can't use cash, which comes back to the point, when we spend using a Visa card, Visa makes money. However, this is probably not enough to offset the impact from Visa's loss in revenue from declining consumption. The silver lining is, we expect that Visa's recovery post this pandemic will be extremely fast. We say this because a lot of consumers probably have a lot of pent-up urges to spend their money. Okay, we're not gonna sit down here and pretend that Visa is our favorite company and that we love their products so much. The truth is, Visa's role in the ecosystem is very silent but super critical. We see Visa as an enabler towards a cashless society, and we are big fans of that. We hate using cash. Just kidding. I'd estimate that nearly 80% of my spending monthly is using my credit card, which means Visa is making money. What's the potential for Visa anyway? 80% of the economy still uses cash to transact, which means there's a long way to grow for growth in Visa. Now, the reason that we chose Visa over MasterCard and American Express is that they are the leader in their industry. They're always one step ahead of their competition in terms of innovation and willingness to explore. Overall, we think that the payment processing industry has a long way to go in terms of growth, and Visa is our pick because of their willingness to lead and their desire for innovation. Visa is our third and final stock in our portfolio. We only put in $50 or 200 ringgit in each of these 3 stocks. We're going to be taking our own advice, and we're going to start putting more money in and save more money so that we can invest more in this opportunistic time. That's it for today's video. Smash the thumbs up, subscribe to our channel, and follow us on Instagram. Peace out. They once held before the lockdowns. Arrgh! Arrgh!